Hey, what's up, everybody? It is Friday, June 30th, end of the quarter. Nice day. Nice day down here, too, in Florida. Every day's nice. Look, I'm not the kind of person who likes to gloat. I think I'm a humble guy. I have humility. But I will say that I'm really happy to see these monetarists and their entire paradigm just get ripped to shreds right here in this market rally. As I've been telling you, like for the past 8 or 9 months, going back to last October when I said, you got to look at the fiscal contraction of last year when we had this it was really like a record fiscal contraction, which the White House was bragging about. I said, but that's the reason for the slow growth, and that ended in October. And that's exactly when I said, you got to start buying stocks again. And but the monetarists, stuck with their ideas. I mean, it's just the thing that gets me about it is that it's just a very wrong and destabilizing, destructive paradigm. I mean, it just doesn't apply. I mean, but they're never going to change. They're never going to change. So if they're not going to change, then it's important. I think it's important that they get shredded to pieces in the markets, and that their ideas are shown to be completely false, and they look foolish by the behavior of the markets, which points to the fact that they're wrong and they don't understand. So and I said that, I've been saying that there's a very good possibility of a FOMO rally, which is a fear of missing out. If you think about it, there's still a lot of them who are short. If you look at investor sentiment, I mean, it's not overly bullish at all. It just recently turned bullish. If you look, for example, at the AAII weekly sentiment survey, or if you look at the put-call ratio, which just finally started to break down through an uptrend line that went all the way back to October. Maybe even before then, I don't know. But it has, it is nowhere near a level on either of those things that would suggest extreme bullish sentiment. So you have to believe, and I think it's true. I haven't seen any specific statistics, but I think that a lot of these monetarist-based investors and hedge funds and traders, they're short this market. They're short this market, and the only time when you're going to see them really throw in the towel and start to cover their positions and go long is when the Feds they need the green light from the Fed. This is all double entry accounting, and I don't know how to make it any simpler than that, but they just never understood that the rate hikes were going to be a fiscal pump into the economy, and it was going to support the economy, and inflation was going to come down because it was a supply chain issue. As a matter of fact, I said today that inflation would be lower if it wasn't, in fact, for the Fed's rate increases. Look at Japan. I mean, Japan still has negative rates, and they have basically, lower inflation. That was the only central bank, and I've given them kudos in the past because they were the only one who rejected the monetarist paradigm. And they just stuck with their policy, and it is an important factor in because Japan is an energy importer, and even during the time that energy prices really skyrocketed during the beginning of the Russian invasion of Ukraine, I mean, inflation, it was very, very moderate in Japan. And that's because they stuck with their policy of zero or negative rates. Whereas the Fed and all these other central banks, they raised rates, and that contributed to a general higher price level. As I've said a million times, the cost of credit is reflected in the cost of all goods and services. So once again, we get back to the fact that it's all based on the macro picture, on macro understanding. Sentiment is also important, and I don't see right now any level of extreme bullishness. Okay? That doesn't mean you can't have a pullback. I mean, we see Apple stock. To me, I get a little bit nervous. I own Apple stock, but when now it's approaching the market cap of Apple stock is approaching the GDP of California, which is the fourth largest economy in the world. Like it's beating out Germany, I think. And it's a little rich when you look at the PE. So there's going to be pullbacks in the market. I mean, but in the bigger picture, like right now in the month of June through the 29th, that's yesterday, we got like a 530 billion leading monthly flow. So today, figure if we had another 16, 17 billion today, that brings us almost to a 550 billion leading monthly flow. Now, I said in an earlier video that the student debt payments, which are going to resume, I think, August 1st, they are going to subtract, okay? They're going to subtract something like 16 or 18 billion a month from those leading flows. So, I mean, we're still going to be at a very decent number, but that will slow the economy down a bit. And I think, that could lead to a slower rate of ascent in the stock market. But who knows? I mean, that could be the thing that triggers the Fed to cut rates, and then the monetarists are going to jump in. Wouldn't that be something that when they finally start jumping in at a much higher level, that's the short, that's the short of all time. But we'll have to see what happens there. In any case, like I said, I don't like to gloat. I'm a humble guy. I came from a blue-collar background. My father was a New York City firefighter. I appreciate the working class and hardworking people. I want to educate and help people to make money and control their emotions. And so, but I'm happy to see this monetarist class get destroyed. And nobody is asking the right questions. None of them. Remember, like a week ago or 2 weeks ago, we had Ray Dalio saying that Treasury refunding was going to cause a gigantic crash in the market because it's going to drain out cash. And I said that was not going to happen. I mean, the list goes on and on and on. It's really, really incredible. But yet these people are paraded around on CNBC and all these other networks, Fox Business, and they're quoted in the Wall Street Journal and whatnot about how today I wrote a thing, how do you get rich as a hedge fund trader? Well, you raise billions of dollars from wealthy people and institutions based on some bullshit resume, like you worked at Goldman Sachs. Then you charge a 2% management fee, which you get no matter what. Then you lose money or you break even, basically, for the rest of the time. But if you're managing, $10 billion, that's $200 million a year. In 5 years, you're a billionaire. That's how you get rich. That's how these guys get rich, off of that 2% management fee. All right. So, that's it. 4th of July coming up next week. And I want to wish everybody a nice weekend. Bye.